Welcome to TradeSpoon and Yellowtown and Tradeer. My name is Vlad Karpel. I'm CEO and founder of Yellowtown. And today we're going to have our weekly broadcast on Tradeer platform on YouTube or on Twitter, X. We're going to talk about different opportunities in the market. Interest rates, gold, small caps, biotech, and banks. Right, to see how we can structure a trade when you see a breakout like in small caps and banks. So that will be the topic of the discussion. We'll talk about earnings and earnings strategies as well. So if you guys have any questions, please let me know. TradeSpoon. All right, Martin can hear me. Good afternoon, Fred. All right, we're ready to roll. That's awesome. All right. Again, welcome. For those of you who are new, welcome. If this is your first live event, this is my bio. My background is different from maybe other subscription or services that you found, is that I have master's degree in computer science. I come from the technology world. I've been CTO of several publicly traded companies. And once they IPO'd, I decided to start Yellowtown. I've been doing this for over 10 years now. And the difference is that we have a team of financial engineers that are using latest advances in artificial intelligence, neural networks, inference engine to make predictions, right? To first cluster stocks into different buckets, different categories. And then once clusterization process is now done automatically by the models, it backtests, learns on the patterns that the stock is undergoing to, and makes forward predictions. Right, whether it's 1 day signal, 10-day signal, or 3-month signal. And then I use these signals in a live trading room environment, and that's the broadcast that you will see today. Disclosures are important. There's risk associated with trading stock or options. If you're new to trading, I encourage you to visit optionsclearing.com to understand the risk associated with trading stock or options. And regular disclaimer, I'm not an advisor. I'm not registered with FINRA or SEC. The purpose of this broadcast is to show you what I do in my own account based on my own risk tolerance level for general education and information purposes only. It should not be assumed that the future trade picks will be profitable or equal past performance. All right. So trading psychology is important. Okay, perfect. Sorry about that. All right, sorry about that. Yeah, so let's take a look. At what happened in the market. So you do have, after the Fed decision last week, it was pretty clear to say that they were now they're concerned about inflation, but they're just as concerned that the economy can slow down and unemployment can grow. So it looks like despite the higher interest rates, despite the higher inflation number for the past 2 months, the path of least resistance for the interest rates to go down, and Fed kind of committed to at least 2 to 3 rate cuts this year. And you can see, if you look at the data, you can see that the 10-year yield has dropped significantly, right? It's broke through the 200-day moving average. It's retesting 50-day moving average, kind of 50% retracement, maybe a little marginal lows for 24.18. But if it breaks through this level, if it breaks through the 50-day moving average, the next level would be 4.05-4% on interest rate, which is very important, right? So interest rates lower after the Fed decision. In terms of dollar, you can see that the dollar continues to rally. It's a little bit stronger. It's trying to break out through this March range, which is bearish for the market. A lot of it has to do maybe carry trade with Japan. Bank of Japan, man, the idea is that they're going to abandon the negative interest rate environment, and people are going to start selling yen and buying US dollar to get a better yield. That is definitely, could explain some of the strength in the dollar, which is usually negative for the multinationals and S&P in general. VIX is complacent, not a lot of fear. We're at almost at year-to-date low or December lows. So everybody is bullish on the market. And if you look at the spiders QQQ continue to make new all-time highs, right? Almost every week we have a new record, and we are maybe retesting or slightly higher than the last week high. So spiders continue to go higher. You see small caps trying, also has marginal breakout, made new March lows, multi-year highs, right? This is, you have to go back to March of 22 to see small caps. And that was kind of the last man standing, right? Almost every asset class except maybe regional banks have been doing a catch-up trade. Even energy now caught a bit, but the small caps were underperforming. And it looks like they're start breaking out, start following the mid cap, right? They're following mid cap, which already at retesting. Basically already retesting all-time highs back to November, right? So large caps, mid cap, now small caps are participating. You see similar action in biotech, trying to break out, right? It broke through this overhead resistance, pulled back to the breakout line, and now trading there again. And obviously gold, right? Gold, it has been extremely strong, new all-time high today. GDX gold continue to benefit from believe that Fed will lower interest rates, and if that's the case, and especially with the inflation, then gold is an asset class that continues to break out. So let's talk about banks, right? We talked about banks this morning. I'm going to just repeat again. Banks also just broke out, right? Industrials. So you do see outperformance of value trades. If you look at QQQ, right? High growth, your Meta of the world, your Apple, Googles of the world. They decisively broke through 2021 high, right? Back in January, right? And continues to trade higher. But if you look in the past, let's zoom in a little bit. We're not making new highs probably for the past 4 weeks, right? And maybe marginal highs since beginning of February, right? Since this initial breakout, since February, we're at 436, so 2% higher since February 5th. But if you look at the value stocks since February 5th, they're significantly higher, right? 152 to 163, 5-7% higher for value stocks, your banks, your industrials, your energy. This is a huge outperformance, and that trade continues on, where perception is that maybe Magnificent Seven a little bit overstretched, right? Including even the leader of the pack, NVIDIA, right? Kind of in the past 4 weeks, not going anywhere, kind of staying flat. And then there's maybe more opportunity, maybe in energy, right? ExxonMobil, we've been trading ExxonMobil, trying to break out. Let's see, did ExxonMobil broke out? ExxonMobil still doing a catch-up trade, or General Electric, right? Industrials. Or banks, right? JP Morgans of the world. And same thing with the materials, right? What is popular material? Vulcan Material Company, right? So materials are also outperforming as well. So that's been a trade, that has been the trend. So this morning we talked about barbell approach, right? We've talked about earnings, that idea that earnings reaction, this earnings season is extremely high, right? You always have a choice whether you want to be long volatility or you want to be short volatility. But in the past 2 earnings season, because there's a lot of catch-up trade, companies like Nike, right? Last week we traded Nike. They get punished if they don't deliver, right? If they have problems with China or the demand is slowing down, you can see people indiscriminately dropping their position. And Nike considered to be kind of a blue chip stock that always kind of goes higher. And on the other hand, if you are Microns of the world or AI stocks and you deliver on the earnings top line and bottom line, you have these outsized move, right? 2 standard deviation, 3 standard deviation moves. And I reference the book by Nassim Taleb. I think I pronounced it correctly. Yeah, Nassim Taleb. Anti-Fragile, right? So he's a quant, made a lot of money in 2008 crisis, kind of now is a speaker, writes a lot of books. It's an interesting book, maybe not my favorite book, but there's some chapters that are very good. right? And he talks about basically asymmetry in risk versus reward, how we treat risk and reward differently. He talks about barbell approach, right? Barbell approach into investing, basically saying on one side, you want to be conservative, right? And maybe do cover calls, right? On the other side, maybe you want to be aggressive and trade more speculative investments. And he is very adamant about structuring your trades where you risk small, right? But you have these outsized returns. The returns versus the risk is asymmetrical, right? It happens rarely, right? It happens rarely, but you're looking for the times where the probability of this outsized move, right, is higher. So in terms of earnings season, right, if we go back to the some of the trades, I think this was Nike. So Nike, right? So last Thursday, right, we talked about Nike, and I was able actually to trade, right? I was invested 44 cents and 76 cents, $1.20, and sold it for $1.70. So 50% return, right? 50% return overnight. So these are the type of trades that Nassim Taleb talks about, right? People do ratio spreads, people do butterflies in this example, spreads, right? So that's one extreme, right, where you're looking for 50%, 100% return of your trade. On the other return, and on the other side, you're doing trades like I did with XLF, right? So today, basically, XLF small caps are breaking out. You can do the same trade on XLF or on IWM, and you're buying basically at $41.88. I bought the stock. It's already at 42.11, so almost 1% gain. 12 plus 11, 33. Okay, 75 basis. So 75 basis points higher, right, in one day, and I'm selling call, right? So that's more or less conservative trade. It's not money market where you get 5%. This is a little bit more aggressive, but you're still trading at the discount. I'm hedged till below 41 level, right? 41.88. If the, let's say, what can derail the rally? It could be CPI data next week, PPI data. It could be unemployment data on next Friday. And if market pauses, right, and at least I'm hedged 2%, right, till 41, almost 3% at this point. 3% to the downside, I'm hedged. To the upside, if I collect 96 cents on a $41 stock, it's 2% return. If I can make 2% return, let's say even every other month, right, plus the dividends, 1.5% dividend, then you can make 12, 15% on that half of your portfolio, right? And again, notice I'm purposely selected the ETF that's at $42 because average account is $10,000. I mean, I can do the same trade with Spiders, right? But probably more popular name. But I decided not to do it because it's a $500 stock, right? And if I'm off by 2%, right? If it doesn't sell off 2%, but 4%, let's say, well, I could be down $1,000, right? 10% on $10,000. I don't want that, right? That's too much risk. But $42, if I'm off by 1 or 2%, well, it's $1. It's within my 2.5%, right? 2.5% risk tolerance, right? The idea is, he also talks about Nassim Taleb. He talks about that you can't really predict black swan events, right? He talks about economists. He's putting down a lot of academics, which I didn't really like in the book, but he reserves to have his right. But he does. But I do agree with him that trying to predict black swan event, right? Or when he was talking about millions of examples, right, where people are trying, or government try to predict certain events, and when you have these events happening in Iraq or in Cuba, he's blaming the intelligence. We blame intelligence or we blame government. In reality, he's basically pointing that these things are so unpredictable that it's very hard to kind of predict, or Arab Revolution, right? It's spring uprisings. It's very hard to predict these events. But to be anti-fragile, you have to be prepared for these events, right? You have to be prepared for these events to make sure. How can you be prepared for these events? Is risk management, right? What is your maximum drawdown? You go through a what-if scenario, right? If the market drops, let's say by 5%, how much is my position going to be down? Well, I have 2% of premium that I collected, and if there is a correction of, let's say, 4% in banks going into the next earnings season, then I will be down $1, right? On 100 shares, I'm down $100. I'm risking less than 2.5% of my portfolio, $10,000, $250. Then this trade is okay. If I do a $500 stock and I'm down $1,000 on $10,000 portfolio, well, then that's not okay, right? So that would be my proposal, right? In terms of this barbell approach, you can have certain percentage of your money in cash, maybe 30% of you in cash, and you're earning 5%. Maybe you have 30% of your portfolio you're doing cover calls on XLF, and you're earning, maybe 15% a year, and then you have another 40% doing these option spreads or buying aggressive short-term trading, right? We have some short-term trading that we did in Yellow Tunnel, let's say today, right? Where did Max send me any more text? No, he didn't. Okay. Where I'm trading Deer, right? I'm trading Deer, bought it at 410.90. It's trading at 411.35. So I'm trying to capture 1%, right? I'm trying to capture 1% or 2%. Not, every other month. I'm trying to do it in 1 week, right? So a lot more aggressive, a lot more risk, right? And this is where you're looking for, greater returns, but you're taking more risk, right, on this trade. Because if you look at the XLF, right? If you look at XLF, going back to our friends at Tradier, right? TradeHawk, my favorite tool in terms of positioning, right? You might not be an option trader, you might be a stock trader, but still positioning is important. And if you look at XLF, you can see there is a large position at 40,000 contracts. No, not contracts, but 40,000 Dana, right? But very large position at 41, people buying puts. So most likely, even if JP Morgan doesn't deliver, right, maybe they don't hit a home run, right, or Bank of America doesn't hit the home run, still yield curve should be steepening in the next year as the Fed is lowering interest rates, and people are well positioned that probably it will not drop below 41, right? Even if the market does drop to 41 or what's next, right, 40 will hold, right? These 40 between 41 will hold because there is a very large position and people are buying puts. So I feel, have more confidence that the 41, 40 level will hold. And you can also see this kind of exuberant excitement in TLT, right? April 19th, which is 3 weeks from now, 70,000 negative Vanna. People are buying 100 call, right? It's trading at $95 with the idea that interest rates will continue to go lower, right? That people are betting that CPI and PPI data will come in better than expected. Unemployment number will not change, right? Strong employment. And you have 10-year and 30-year going to drop, right? 30-year already dropped below last week low, right? So 30-year is already below 50-day moving average, below 200-day moving average, on its way to retest 420. So that would be my thought process. Any questions? Sorry about that. All right, I can hear, see you. Good afternoon. Okay, perfect. Sorry about that. Okay, so that would be my approach to some of these trades. What else? Earnings, right? So I'm not going to do it in my live account, because it doesn't have weekly options. Earnings season is kind of winding down, right? The new one will start in the next 2 weeks. But there's still earnings every week, right? GameStop was one of the earnings, right? And actually, I only did call spreads, right? If you watch me I was watching Dumb Money, got inspired by GameStop. Maybe, people are still gonna be, I wasn't the only one in GameStop. There was a very large position at the 22 strike, right? Very large position at 22 strike, basically saying, I don't know if it's still there, probably not. Kind of worked. Yeah, it kind of disappeared. Now it's at 20. So there's still a very large position at 20, right? A lot of open interest at strike 20. Strike 20, which is 50%, more than 50% out of the money in 3 weeks. All right, so there's still a lot of people enthusiastic and want GameStop to get to 20. So I kind of follow them along before the earnings. Again, risking 23 cents, potentially if the trade was going in the right direction, I could have made up to $3, right? So you could be 10 times return, right? 10 times return. I didn't do put spread. If I did the put spread, I would actually be profitable because GameStop, you can see again, outsized moves. It moved at this point 20% down, right? So it's down 20% from the 16 level, $4. If I moved, did a similar trade on the downside, then this trade would have worked. So the butterflies allows you to risk small, right? Well-defined risk, and then you have outsized trades. SMTC, also very volatile stock. It's a semiconductor. It has been outperforming the market, underperforming the semiconductors, but also pretty volatile earnings, right? That earnings can move. In here, it moved, I think, 22%. It dropped 22%. So it's a pretty volatile stock when it comes to earnings. They're announcing earnings after the close. Not very liquid. The reason I don't want to do it because it's not very liquid. That's one of the issues. And it's also not very liquid, and it doesn't have weekly options, right? So when I trade, and I want to give examples, I want to trade liquid names that trade well, and that's why I'm not going to do it, right, in the account. But in my personal account, I did the butterfly puts and calls with the idea that it can move 20%. So if it does move 20% to the upside or to the downside, same thing. You can risk maybe 40, 50 cents. The only problem would be very hard to get out of this trade next week, right? Because there's only April expiration. But that would be example of similar to Micron and Nike that we did in the past couple of weeks. This would be SMTC announcing earnings after the close. I mean, not a lot of volume, right? Only 3 million shares, no weekly options. So it's not the best example of how you would learn about butterflies, right? When you do Micron, Nike, this is a good liquid names that you can learn how to make the trades. This is not a good, this is only if you have an opinion about, that the stock can move 20% and you don't want to risk a lot of money because these options are very expensive. Implied volatility is over historical volatility is 100%. By April, I think there was maybe 40% by April 19 that it will move. Let's see, SMTC. So relatively large position at 30, right? That will be 10% by April 19. And by May, potentially 32. But at least till 30. So you can do strikes like 30, 32, 34, right? On call spreads, and same thing on the put spread, maybe 26, 24, 22 put spreads. But a lot of action is basically concentrated on the call side. Any questions on butterflies? Hedges, spreads, MSCI, Nico, can you check when a position for me? Yeah, SMCI. Let's look at SMCI. SMTC is not SMCI, right? Super microcomputer, right? Kind of triple top, classical triple top, gamma squeeze, right? If you look at GameStop, I was watching the movie Dumb Money after the COVID. I mean, similar pattern, right? The stock after the hedge fund bankrupt, right? It started like, I think the movie starts at $4. I mean, it went to there. It's at 300. I don't know if there was a split, but at least the chart showed 300. But same thing, right? You have these double tops, triple tops. Right, some events like Robinhood decided that they got issued a margin call, right, where I forgot, Options Clearing House basically had told them like you have to put up $3 billion to cover all these positions that retail investors. They didn't have it, so they decided we're just gonna stop trading. We'll not allow people to buy calls and open new positions, right? And this was all in Robinhood, so you have this huge drop back, right? And then people's, there was a congressional hearings, it went going up and then went up again, and then since then kind of one-way trade, right? So SMCI, I'm not insinuating that SMCI is going to have a similar fate. At some point it will. I'm not sure if it's going to be the next year or 5 years from now. It's probably going to be at some point $200 stock, but it has to have bad earnings, right, or some kind of an event. Until then, it's probably not going to be there, but you can see it's kind of losing momentum. So in terms of positioning in SMCI, let's see, April 12th. So you have March 28th, we can forget about it. Okay, so next week and April and May. So a lot of it's trading at 1,000. There are people basically selling, right? Risk reversal. People are selling 900 call, basically saying we will not drop more than 10%. So you sell 900 call and you buy either 1,100, 1,200, 1,150, or 1,200, right? Not a huge position, right? It's not a very liquid name, but nonetheless, that would be the trade, right? So people selling 900 call and using that premium to buy, 1,100, 1,200 calls. More liquid name like Micron or even NVIDIA. Well, forget, the comparison should be NVIDIA. NVIDIA is a lot more popular, right? That's a Magnificent Seven, a lot bigger positioning. So this is 2,500, right? So much bigger positioning, and basically people are selling. It's trading at 900, 850. So people are selling 850 put to finance calls that expire actually next week. So next week, someone thinks it's going to be to get to 940, and bigger position, the May contracts is 1,000, right? So pretty large positioning at 1,000. So basically saying that we're going to go up by 10% by April or May. In terms of hedges, I do have an SH. I still have a small position in this SH. I think right now, if you look at the positioning, right, first of all, from seasonality point of view, we're in a very bullish time of the year, right? So unless we have a pretty large CPI print, I think the risk is the other way, that CPI is going to come in better than expected, and then you will have a pretty significant rally, I think, because that's kind of what holding the market back. But we are pretty well positioned to 510 or somewhere here, 50,500. So we're pretty well positioned at 500. We're very well positioned at 540. And we're trading at 520. So I think right now we're in the middle of the range between 520 and 540, right, in terms of positioning. In terms of trade spoon model, right, for April, I mean, we're done with March. Let's do April. Model sees 486 to be support 537, right? So we're still kind of maybe in the middle of the range. And I think the bias is to the upside. So I do have a short position. The only short position I have left is I have small position in SH in case we do get to 500, 490. So one way to hedge is SH, right? If you're not comfortable trading SH or you want to be more aggressive, you can buy QQQ put spread. I would go with QQQ because it doesn't look like QQQ is going anywhere, right? It's kind of stuck in this range. So if you think it can pull back, then I would buy, 450, maybe 450 for 30, 450 for 30 debit put spread. Volatility is low, and you're basically saying that it could drop to 430. And then if you look at the QQQ positions, I mean, the biggest position is 430. So we're pretty well positioned to 430. I don't think the market is going to drop below 430 anytime soon, but it's also not going much higher than 450. And you see a lot of calls selling at 450, 455 level. So that makes sense to me. So if you want to hedge, that would be my trade, right? You buy QQQ 450 and you sell 430 in May, right? The trades in May. And, QQQ continues to be weaker, right? It's unable to break through this uptrend. So that would be my trade in terms of hedging. Fred, thank you for asking. That should middle number of butterfly be above or below? Middle number should be at the strike price, right? So when you just, let's say you want to do NVIDIA, right? Let's say you want to do NVIDIA. Risk less, or I did IWM. I'll do IWM in my personal account. April 19th. So you have a huge position that expires in April at 215. Right? You have a 215. 60,000 people, 60,000 very large banners selling the calls. That is probably where the stock will gravitate toward between now and April 19th, right? So in the next 3 to 4 weeks, IWM will gravitate toward that level. In May, I mean, a lot less positioning. So a lot of people basically betting that unemployment will be standard, no big surprises, no down surprise. And they're betting that CPI and PPI will come in better than expected. 10-year, 30-year yield will drop, and small caps will rally. So they're basically saying that it will, in the next 3 weeks, it could get to 215. We're today at 211, 210. So then the middle strike in the butterfly would be 215. I mean, the next one is 220. So somewhere between 215 and 220, where you want it to be that short middle strike. So you can be long 210, short 220 2 times, and long 230. If you want to be a little bit narrow, April only 3 weeks left, probably not going to get to 230. Okay, then you do 210, 215, 220, right? But these are the candidates for this. You know that there's a lot of bulls and bears are going to fight at the 215 to 20 level. Since you have that information, right, this is not something I decided, this is something that you can see based on positioning, then then 215 to 20 level makes sense, because this is, you have to go back to 2022, right? The beginning of the, I mean, small caps started selling off a little bit before the market. I think they reached the top. Sorry. So small caps reached November of 21, right? Large caps, this was January of 21. Small caps rolled over in November 21. So you have to go back to reach 220 level. You have to go back basically to January of 21. So that's the catch-up trade. Any questions? Ted, thank you. Bob Nickel, I mean, I know Fisker is in the news, right? Bankruptcy again. I think they got delisted, right? Fisker has got delisted. Yeah, Fisker, I think it's over the counter now. So Fisker got delisted, right? And then Nikola is probably, is it up or down? I kind of assume it's gonna, well, it's a penny stock. I mean, yeah, I mean, it's, you know, I wouldn't, I mean, it's obviously up today 12%, but it's a dollar stock. This is, you know, this is meme stocks. Futures trading coming to trade you soon. Thank you, Bob. Fred, thank you. Ted, thank you for butterfly analysis. All right, let's review the rest of the positions quickly. See if anything. Oh, first of all, let's just, so NVO. So, you know, this is another example where you can buy stock, right? So I did buy NVO. Let's do this in yellow tunnel, profit accelerator. So I did trim the position. So I bought it at 128.96. I trimmed it at 130, and now I have position to close at 132.90. It's at 128.61. So this is, and I closed JP Morgan. I closed JP Morgan. So these are, so I'm doing, you know, option spread strategies, you know, more conservative stocks strategy, longer term, like cover call or spreads like ExxonMobil that I just closed, and then stocks, right? Short-term stock trading, which is more aggressive, you know, a short-term trading. Cecile, yes, 210 to 20 to 30, or 210 to 15 to 20. I think both. I mean, 215. I mean, if small caps do break, I think it could get to 215 rather quickly. It all depends on CPI and PPI data. I mean, spent, no, I think 215, yeah, 210, 215, 220, that's probably the cheapest one, right? And I don't think it's going to get much further than 220. Probably will gravitate toward 215. right? If I have to guess, it will gravitate toward the strike, which is 215. A huge position, right? 60,000 contract, like TLT. These. I mean, they're all the same trades, right? This was all bet that CPI and PPI data will come in better than expected, right? And yield will drop, right? Yield will drop. I mean, TLT 70,000, right? This was like a silver trade, right? When we had silver trade, it was, I think, 100,000. What is silver now? I think people are kind of moved on from silver trade. No, still 25 strike, right? So very large position by April 19. In 3 weeks, that silver will be $25. I mean, that's not almost, it's 10% higher than it is now. So somebody thinks that silver is going to go up 10% in the next 3 weeks. A lot of people, not just someone, a lot of people. You need unemployment data to be better than expected and CPI and PPI to drop. Then yes, gold breaking out, GDX breaking out, silver breaking out. You have these large positioning, dealers have to hedge, and, it will look like GameStop in 21, right? No, I'm exaggerating. It's not going to be a GameStop, but it's good. I mean, 10% move is a significant move in short term.
Hi, Vlad. The control panel is blocking your screen.
Oh, okay. Sorry about that. Sorry about that. Okay. I keep forgetting that. I gotta use multiple screens. Okay. Thank you for letting me know. Okay, sorry about that. So silver, yes. So silver is a large position. All right. Any other questions? All right. Okay, if there are no other questions, that's all I have for today. Thank you very much, especially our trader, Max. Thank you for allowing me to broadcast. Hopefully, you can find us on Twitter, right? So we do have a lot of valuable content on Twitter. Search for the word yellow tunnel, handle tunnel_yellow at tunnel_yellow or yellow tunnel. Subscribe, and we do have broadcasts from Tradier, right? We have a blog, we have videos that, a lot of good content that hopefully you will enjoy. So please follow us on Twitter, yellowtunnel.com. Or you can follow Tradier, just search for the word Tradier on Twitter as well. All right. Thank you very much. Have a great day, and I will see you guys soon. Thank you.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.